Hello. This is a debrief of the September-December 2022 SBR exam. You can find the exam on the ACCA practice platform. You will need to work through each question before you watch and listen to the debrief. So we'll take a look at question 1 called Sterling. The group account question, year end is March X9. First part of the scenario, 2 requirements. How would Berthold be accounted for in the profit and loss? Not the balance sheet, just the profit and loss. And what would the goodwill be, presumably on buying Berthold? Notice the slightly different dates. The first part is explaining everything about the profit and loss for the whole year. The second one is just identifying the goodwill balance at one date, 9 months into the year. I expect that's the date when we got control. If you need to, pause the recording now to make sure you're happy with the scenario. So in this scenario, we originally bought 40%. We've now bought another 35%. We did have significant influence. We've now presumably got control. So we've gone from associate to subsidiary. Now, that's a fairly straightforward situation, isn't it? You know that for the first part of the year, it will be an associate. Then, partway into the year, when it becomes a subsidiary, they'll recognise goodwill, and there'll be a profit on disposal of the associate when you say goodbye to the associate. For the last part of the year, the company will then be a subsidiary. We're being asked to both explain and calculate. As always, the explanation is the important part. And please remember, explanations are not journals. So you need sentences saying actually what's going on. In this situation here, 3 sentences, aren't there? One about it being associate, 1 about the change in status, and 1 about it being a subsidiary. The numbers you probably found quite straightforward. So explanation. First 8 months. Why is it an associate? And therefore, why are we therefore equity accounting? Last 4 months. Why is it a subsidiary? And why are we consolidating? You'd want to explain briefly what equity accounting means. Cost plus share of profits, post-acquisition profits. You'd want to explain briefly about consolidation, adding income and expenses line by line, but I'm sure you can do that. Then we've got the crossing the threshold moment, the 1st of December, when the investment in the associate is remeasured. Some people say that. Some people say it's a profit on disposal of associate. It doesn't matter. However you describe it, you compare the proceeds, or the cost rather. Again, you're comparing, the fair value with the carrying amount on that particular day. Calculation-wise, pretty straightforward. We know that the change takes place 1st of December. That's 8 months into the year, isn't it? So for 8 months of the year, it's an associate. While it's an associate, we're told that the profit for the year was 11.1. So here I am as an associate. There we are. 40%, 11.1, 8 months. When you come to do the subsidiary later in the year, the last 4 months, then you'll consolidate line by line and you'll then take out the NCI. So the NCI would be 4/12, 4 months of the profits, again, times the NCI percentage, which would be 925. Finally, the profit on sale of the associate or remeasurement of the associate, just the bit I'm now highlighting in yellow. Here's my working to get to that 2080. What's the fair value? We're told the share price of this associate, which becomes a subsidiary, on the date of the change. The share price on that day is 920. That's what we need for the fair value. So I add 40% of the shares at 920. That's the fair value. 40% at 920. Carrying amount, equity accounting. What was the original cost? Easy, 25 million. Share of post-tax profits, harder. What are the profits, again, here, on the date of the change, the 1st of December? And I'm having to compare that, aren't I, with what the profits were originally at acquisition. So that's the 1st of December. This one here is when they originally bought the associate. Hopefully we can see those numbers back in the scenario. There we are. When we originally, again, bought it, retained earnings were 18. On the change, they're 42.3. So while it was an associate, the profits went up from 18 to 42.3. Our share 40%. So the adjustment, again, 2080. Don't forget to tell the examiner where that's going. It's going in the profit and loss. We were also asked to calculate the goodwill on the date of the change. I think that's straightforward. I think we're just asked for a calculation, aren't we? So, explain. So we do need to explain as well as calculate. So fairly standard sentences. Goodwill is the fair value of what we pay versus the fair value of what we get. And then you can expand on that a little bit. So fairly standard sentences to explain the goodwill. In particular though, the fact that the original 40% stake is being measured at fair value as opposed to the historic cost. So here's my goodwill calculation. Explanation, everything at fair value. The fact that we've used, again, the share price of the sub for NCI. From requirement 1, the original 40% now measured at a fair value of 36.8. Can we see that upstairs? Yep. 36.8. Then the cost of the 35%. If I've got 75, the minority have got 25. Again, using the share price of the subsidiary, that's the 920. Less net assets. We must have been given that somewhere. 55.3. You can just pause this as much as you want to, can't you? Net assets, again, there it is. I'm just highlighting it in green. Net assets, on the date we get control, 55.3. Very nice little question that, isn't it? Very nice 14 marks. Nothing to be fearful of. I would think that people would do well on that. Explaining and calculating the goodwill. Explaining and calculating the change in status. Let's move now to the next requirement. So once again, the directors want some advice and they want some calculations of an investment in malting. Notice two things. First of all, you're asked about how it would be in the parents' accounts. And secondly, how would it be in the group accounts? 30%. So your brain would say this might be an associate, or it might, of course, be a joint arrangement. So if you need to, just pause the recording now and read the scenario. We can see the magic words, can't we? Unanimous consent. That implies that each party has a right of veto. That therefore applies, it's a joint arrangement. So this is a joint arrangement. It seems to be a company. It's described as Malting Co. And the share that we have is in its net assets. So is it a joint operation or is it a joint venture? It's a joint venture. Joint operation is where you would own half an asset, like half a calculator. Joint venture is when you own half a company. So, or 30% in this case, it's a joint venture. So the key sentences are, this is a joint arrangement. Why? Explain. This is a joint venture. Explain. This is equity accounting, and then some numbers. So my explanation, here it is. Just look at, there we are. Just look at the bit I've just got. I'll just put it in a box for a moment. Don't worry about the numbers for now. The key thing is, joint control means joint arrangement. Joint venture, one of the two types of joint arrangement, because it's a separate legal personality, then it's equity accounting. But we weren't just asked about the position in the group accounts, we were also asked about the parents' accounts. Now I can't do anything about it, but the accounting standard says you can either use cost or equity accounting or fair value, as in financial instruments fair value through OCI or something like that. So you might say, well, why would they want to mess about? I don't know, but it's a point of knowledge. It's come up and it's come up before and it will come up again. This is whether it's an associate or a joint venture, it's the same. So this bit here is just one of those slightly irritating things that you need to learn. The parent can book it at cost, equity accounting or fair value. The group accounts, though, of course, it is equity accounting. So cost plus share of post-tax profits. The cost, cash plus loan note. What does that mean, loan note? It means, doesn't it, they're going to pay later. That's all it means. So the investment, the cash is 2.5 million. The loan note has got a fair value of 1.3 million. Remember, everything is booked at fair value. So the cost is 3.8 million. The profit in the year was actually a loss. Be careful, because this investment was made on the 1st of July. Our year end, I think, is March. Is that right? Yep. So July, August, September, October, November, December, January, February, March, 9 months. So it's only being equity accounted for 9 months. So to be honest, I forgive you if you put 30% of 800 or minus 800. I think technically it should be 9/12 though, because that 800 figure was for 12 months and we only had influence there for the last 3. Either way, carrying amount 3620. Let's move to the next part of the question. Here we are, something about something called batch. Let's just read the requirements C. Batch is a discontinuance. Well, that's good. We know how to explain those things, don't we? We need to calculate goodwill, which arose years ago. That must be when they bought batch. And also how it will be measured just at disposal. Wow. Discontinuance. Knowledge. Remember, it's where you have a separate major line of business or geographical operation and you discontinue it. Again, in that case, what's going to happen is that in the profit and loss, its results will be shown as a separate line and they'll adjust the comparatives. They'll also need to think about the carrying amount, comparing it again to what we're actually going to sell it for in case there's any kind of impairment. Now, if you want to, pause the recording for a minute and read the scenario. Okay. The easier part is probably going to be to work out the goodwill. The rest of it, again, is going to be slightly tricky, isn't it? Just to try and put all these figures together and also to put the explanation down. But we understand, again, that there is this discontinuance. So how would it be accounted for? At the 1st of Jan 09, let's take our way through. The first point is, of course, that on the assumption that this qualifies as a discontinuance, and my assumption there is it's either got to be discontinued or held for sale. Again, presumably it's going to be held for sale. They need to write it down to the lower of the carrying amount and fair value less cost to sell. So, in addition, they will also need to report its results separately again in the profit and loss. So I might just add that in as an extra point. So also, again, he did just say generally, how do you see it as in the accounts? Yeah. So I'd also want to say that in the profit and loss account, again, then it will be shown as a single line for the discontinuance. Now, we need to value it at the lower of the carrying amount and fair value less cost to sell. The fair value less cost to sell is not a problem. It's 4.4 million. Let's see if we can spot that. I'll just highlight that again in a moment in yellow. There it is. There's the fair value less cost to sell. That's fine. It's the carrying amount that's the problem. Now, the carrying amount of a company is the value of its net assets plus its goodwill. So back across here, I'm now thinking about this 4.6. The 4.6, as we're going to see in a moment, is the net assets plus the goodwill. So you can see it down here in my working. There's the 4.6. The goodwill is straightforward because to buy the company originally cost 3.1 million. And that was at a time when its net assets were 900. Sorry, its NCI was 900 and the net assets were 3.6. Let's see if we can see those numbers. I'm just going to highlight them in green. Originally they paid 3.1. The NCI, again, the net assets was 3.6 at fair value, and the NCI was 0.9. So goodwill, 3.1 plus 0.9 minus 3.6. There it is, 400. So this figure is not a problem. The one that's harder is the net assets. I need to know at the date it becomes a discontinuance, what was its share capital and what was its retained earnings. Well, share capital, again, I'm just going to highlight now in blue. The share capital was 500,000. The net assets, or the retained earnings at the date of disposal, here we are, 1st of Jan 09, that's 2.9. I presume that that's the cumulative figure. All good so far. There's also a fair value adjustment, because when we originally bought the company, there was a fair value adjustment. You see, when we originally bought it, we had share capital of 500, retained earnings, let's see here, when we originally bought it, were 2.1 million. Just highlighting that now in yellow. And the total consideration was 3.1 million. So back here, 2.1. They paid 3.1. So there must have been, again, a fair value adjustment there of, now that looks like 500, which doesn't sound right to me. Let me just have a look. 3.6 minus 2.6, that's 2.6, 3.6, 3.6. I've picked up a figure wrong, I think. Let's have a look. Oh, silly boy. The net assets were 3.6, weren't they? What a silly tutor. Right, so this one was 3.6. And again, my computer's being unkind. So this would have been 1,000, a balancing figure. I've actually put it better down here. You can see it down here. At acquisition, there would have been a fair value adjustment of 1,000. But this relates to an asset that depreciates. And I think we've had this asset now for 2 years. So it would have been depreciated by 2 years. 1st of Jan 07 to 8 to 9, 2 years. The life is 10 years. So the remaining fair value adjustment would be 800,000. And that's the figure that's coming back in here, back upstairs. There we are, the 800,000. So finally I can see the total net assets were 4,200, highlighting now in green. Well, we'll try for a green. So net assets plus goodwill, the carrying amount is 4.6. Here we are. Seem to have made a big horlicks of that, don't I? But we're okay. Back upstairs. The carrying amount is 4.6. Fair value less cost to sell is 4.4. As a result of that, then, impairment is 200. Don't forget, you can pause the recording at any time if you need to make notes. I'm just going to put the workings up together just so that you can actually pause the recording if you want to. So here's working 1 and working 2. I'll just leave those on the screen. Pause the recording if you're making notes. Then here's that fair value adjustment again if you're making notes, just pause it again. So overall, we've said it looks as if that on the disposal there is an impairment of 200. Now remember that when you write down a subsidiary, you write down a cash generating unit, goodwill is always written down first. So that 200 will reduce the carry amount of goodwill. Those of you that like double entry, that's like a credit. Because we're using full goodwill, the debit will be 70% will be against retained earnings and 30% against the NCI. So the impact of all of that then is that in the profit and loss we'll show a single line for the discontinuance, and retained earnings in reserves will go down by 140, NCI by 60. In the balance sheet, again there'll be a decrease in goodwill of 200, again when they're sorting out this discontinuance. It's all right, isn't it? It's a bit messy with the numbers and a bit harder sometimes to explain what's happening there. But there's my debrief again of question 1.